the price is up, all-time highs, yet a lot of investors are not satisfied with the performance of the equities. And so I wanted these three gentlemen to join me on stage today and do a couple things. Maybe provide some answers and insight as to why that might be the case, but also some context. How true is the statement? And maybe, Adrian, I'll throw it over to you to begin. Wow. Because you pushed back, I think first, you're like, well, let's just wait a minute here. Equities have performed, right. Certain equities, right? What's your take?
Yeah, I mean, so if you look at the last 12 months, for example, the last 12 months, the XAU is up 31%. You know, that's nothing to cry about. That's not so bad. Obviously, it hasn't really trickled down to the juniors, apart from very, very selective juniors, but that's always the way at the beginning of a bull market, isn't it? But at the beginning of a bull market, you know, you have to have a catalyst, you have to have a great drill result, or you have to have a great discovery, or you have to have something to make the stock go up. You know, the rising tide, raising all ships doesn't really happen, all boats, doesn't happen till the end of a bull market. There's no question that the gold stocks have not given us the leverage that we expect at the beginning of a bull market, right? I mean, gold and gold stocks, depending on the time frame you use, are up either around the same or indeed the stocks have underperformed the metal. The reason to me is really quite straightforward. If you look back at the last 2 years or since September of 2022, gold is up over 70% in US dollar terms, but why is gold up? Who's buying it? The people that are buying gold and the reasons that they are buying gold are not the traditional reasons that people have been buying gold. So if you look at the central banks buying gold because of a need to diversify their reserves away from the dollar because of dollar weaponization, well, it's obvious that the People's Bank of China is not going to be buying Newmont to achieve that objective. And so the people that have been driving the gold price for the last 2 years are buying physical gold. They're not buying gold stocks, but it's logical, it's not illogical.
Yeah.
Yeah, I'll just reinforce that. I just spent 3 years as chair of the World Gold Council and watched central bank interest step up on a continual basis and record levels for the last couple of years in terms of their own purchases. So to echo what Adrian's saying, this bull market started unlike any other bull market that we've seen in my time in this industry, which, as you can tell by my silver hair, is a while. That's an investor group that doesn't chase the ETFs. We saw ETFs actually drop over the last couple of years, now starting to bounce back up again. And they don't invest into the equities. And so all the evidence supports that this bull market really started from a different spot than what we've ever seen before. But we have seen the ETFs pick up. We have started to see some appetite. And so I do think we're very early in this game, and the equities always follow in this. So there's no doubt there's still space to go to catch up in terms of where we are. When I sit and look at how much of a record gold price we're looking at right now, this should be a ripping market. And when the West wakes up and fully embraces it, it will be a ripping market.
Amen. Just to follow on both of those bullish outlooks, I will say I'm kind of like a lot of you guys. I actually don't have any other stocks than mining stocks, and principally it's gold and silver. This is it. It's worked out pretty well over my career. Most of them are companies that I'm developing. A very large stake in Equinox Gold, for example. That's my main gold play. But a year ago, I said at this conference that this disconnect between the gold price and the gold equities is really weird. I mean, I can go back 70 years post-war, and generally speaking, gold and gold equities have traded in tandem. It's been a cyclical world, but they go up together and they go down together. Starting in about 2022 or 2023, after the Russian invasion of Ukraine, a lot of these big central banks decided to move away from the dollar into other asset categories like gold. And so we had this crazy disconnect for exactly the reasons that Randy and Adrian have just mentioned. Things are weird right now. Things are weird. It's a very odd market. It's a bull market in gold. Gold had a spectacular run last year, and every analyst under the sun, I think, is pretty bullish on gold continuing to do well in 2025 and so on. I mean, why would it change? It's the fundamental factors there for gold to do well are still there. The answer, or the question for all of us here, and I'm in that category in a huge way, is why haven't the equities performed better? And to Adrian's point, they didn't do badly. In fact, in between February and October this year, gold went up 20%, but the GDX, the index of the large gold companies, producing companies, went up 52%. And over the same time, the GDXJ, the juniors, but mostly producers and liquid exploration companies, went up 58%. So it was a pretty good market. The leverage was there, but it wasn't nearly to the extent that we've seen in previous markets. And of course, a lot of that was given back in the last couple of months. And really, the juniors haven't moved at all, the companies that are here. And I own a bunch of those. I went long a year ago because I just couldn't stand this disconnect. It's not natural, it's not normal. There's usually a reversion to mean in most commodity markets, which is going to be satisfied either by gold prices going down or gold equities going up. And I don't see why gold prices should come down. Therefore, I thought it was a pretty good time to be buying almost across the board gold equities with the most beta, the most volatility, the best upside, the most leverage, really being in the small companies, either producers or really good explorers that have great assets and are just cheap as borscht. And so that's what, I bought a bunch of last year. Quite frankly, those have been flat. Net, they've been pretty flat. So, some have gone up and then they came down and some went down and they went up, and it's sort of been a flat year. So I just think right now, it's an unnatural, kind of a weird market. It's likely to rebalance, and I'm going to bet exactly like my friends here on the podium are saying, it's going to be gold equities are going to move up. This year, it should be a pretty good year.
I pulled up some stats before this panel, and you're all legends in the space, of course. Randy, your company performed especially well. Wheaton Precious Metals over the last 5 years is up 115%, outperforming gold. So you're one of the companies that have done it. How?
I think we've created a business model that allows investors to take a very low risk level. I like the phrase that Jay used in our earlier discussion over on the stage there. Foundational base. And to echo what Ross says, I think a portfolio should be mixed with good solid core assets and then some risk capital to get that optionality, to get that leverage. And so our company, with the business model where we take out the cost risk, and I'm come from the mining industry and I've built and run a couple of mines. I know how tough it is to deliver on operating cost promises, on capital cost promises. Just seems like you're always dealing with challenges in terms of delivering on time, on budget. It's a continual pressure, and to be honest, it's even made worse, weirdly, by the fact that we've got higher commodity prices, because higher commodity prices means lower grade material becomes economic. And as soon as lower grade material becomes economic, the cost per ounce is going to climb. And so that cost challenge is a real, it's probably, when I look at someone that's skilled in the mining business, they're skilled at managing those challenges and coming up with the right balance that delivers returns to shareholders. Our company takes that risk out of the equation, right? And so I think that's what we've done, is provided that foundational exposure at Wheaton to allow people to have a core investment and good exposure, leveraged exposure, although not to the degree that the operating companies do, because our cost per ounce is so much lower, but still have access to exploration success and upside expansion potential all the way across the board, and more importantly, the commodity price without that cost risk. And I think that's one of the reasons why as interest has picked up, our company has been sort of flagged. I think there's no better way for a generalist that's never invested into the gold space to get their toe wet with Wheaton and try that in the streaming space, and then understand a bit more. And then as you get more comfortable in the marketplace, you look for the higher leverage opportunities. And in a bull market, it's you pick the right opportunities. You can have some screamers, but it does elevate a higher level of risk. And so you just got to find that balance. And I think that we represented the part of the group that's starting to bring in the investors first, and that probably is reflected in that performance.
Yeah, and Equinox Gold as well, a company that you're chairman of, Ross, over the last 12 years, up 44%. Gold over the last 12 years. We're counting, of course, the 2011 high.
You're talking Equinox Gold?
Yeah.
Yeah, well, Equinox Gold is really an 8-year-old company, sorry, 7-year-old company. We reorganized, we did a merger back in 2000 and end of 2017 to create Equinox Gold. Changed the name. Anyway, that's the story, and it started with no assets of production, but a big mission to build a really big operating gold company. And so 7 years from, from not much to where it is today, it's about a $4 billion company today. We have 8 operating mines, produced 620,000 ounces last year. We'll produce a lot more this year, and our cost structure is going down. We just finished a huge mine construction in Ontario called Greenstone. And I think to the point of how the stock has done relative to the gold price has been great. We started Equinox in the beginning of 2018. Gold was $13.50 an ounce. And so it's doubled. It's $2,700 today. That's a happy result when you're trying to build an operating company. And we've grown from no assets or no production to, we produce a lot of gold now. We're on target for 1 million ounces in the near future, with about 30 million ounces of reserves and resources. So it's a very levered company. But the stock hasn't done as well as it might have. But on the other hand, to grow quickly like that, you have to do a lot of M&A. We've built 4 mines. We've bought 2 companies. We've sold 2 mines. It's been an extremely active business. We've raised billions of dollars. We have $1.3 billion in debt, for example. Nobody likes debt. We just finished a huge mine construction last May, and a week before the mine opened, our partner said they wanted to sell their interest, and we bought it for $1 billion. So we had a lot of these things that tend to discourage investors in the sense that when you raise more equity capital, it's not a great thing to do. You add more debt, it's not a great thing to do. You have risk building big mines. There's capital risk, there's schedule risk, and these are all things that can go wrong. So last year, the year before, the market was rightly concerned about whether we were going to do that. We've done it now. The mine's up and running. This year, I think it's going to be a great year. We don't have any of those, you could say, headwinds to equity price appreciation. Those are behind us, and I think we're going to have a really good year. We're making a ton of money. We're paying down our debt, and that's usually a pretty happy story for investors.
Adrian, I'm not sure if you covered this already in the first couple of minutes, but the types of investors in the gold market are important, right? I mean, the Chinese buying the gold bullion, but the central banks aren't buying Wheaton Precious Metals or, Ross Beatty's company, for example, right? Is that going to change?
Well, it's not going to change if the central banks are going to start buying Wheaton and Equinox, no. Yeah. But it'll change when Western investors get back into the gold market. And at the moment, particularly in North America, we're continuing to see outflows. You look at the GLD, even in physical gold, you look at the GLD, and since the US Thanksgiving, so that's the end of November, there have only been 4 days of inflows to the GLD. So North American investors are simply they're not buying gold, let alone gold stocks. GDX, GDXJ also have, on balance, net outflows over the last month and 3 months. I think, part of it is because of the Trump election. We saw gold fall when Trump was elected, and then, the central banks came back in and filled that void. But there's optimism about the U.S. economy. There's optimism about U.S. inflation. There's optimism about the U.S. stock market. I think that optimism is a little deceptive, frankly. I think people are too optimistic on it. But the plain fact is, if people are optimistic on the economy and optimistic on the stock market, they're not looking at gold stocks.
And another point that you brought up earlier to me is in 2011, the last bull market, perhaps mistakes were made by some seniors on the acquisition front. Perhaps generalist investors are a little bit turned off by some of the mistakes made in the last bull cycle. I mean, can you tell us about that?
Well, I'll go first. I remember when I first got into this business, if you looked in 1990 or 2000 or even 2005, 2010, pretty much any mutual fund in the world had some gold in it. It could be a small cap growth fund, an Asian growth fund, whatever. Everybody had some gold exposure. If you look today, I don't know any funds other than dedicated gold funds, maybe the first Eagle fund, but other than that, I don't know any mutual funds that have gold. It's something they're just not interested in. And why is that? Well, they've been burned, in my view, they've been burned too many times. Certainly in 2011, sometimes the industry's fault, sometimes not the industry's fault. But in 2011, you had companies going out making marginal acquisition, overpaying for marginal acquisitions, and most of that money was written off. And so when a generalist buys the best companies, they buy VRIC and Newmont, and then 6 years later, they're down 50%. They say, I'm not sure I understand this sector, but I know for sure I don't want to invest in it. They slowly, steadily came back, and they said Franco. Franco's the biggest, at the time, the biggest of the royalty companies. Nice, you know, a gold investment that works, right? And then we had Cobre Panama. Not their fault, perhaps. We could argue about that. Not their fault, but, you know, Cobre Panama happened, and he said, oh, here we go again. And then you have Mali, you know, stealing gold from VRIC. And I think generalists just, if you don't know the sector well enough, you just say, this is not a sector I want to be interested in, you know, I'm interested in.
Is there also just a lack of interest in consolidation from the mid-tiers and seniors, thus putting off generalists who want to buy their juniors as takeout targets? I'll let you start first, Ross.
Well, the business is pretty interesting that way. There's always takeout targets, and there's always great discoveries that create, you know, fundamental value for shareholders. I mean, we had one this last couple of days with Amark. Really nice move and, you know, a nice discovery. And because this industry is fundamentally a depleting industry, right? Every single mine eventually goes out of business. It's a non-renewable resource. For a mining company to stay in business, they either have to discover or they have to buy. They have to replace the reserves one way or the other because they're simply depleting every single day of the mine's life. And so there's a natural built-in ability for smaller companies, the sort of feeder companies, to discover things that the larger companies want to buy. They'll pay a premium, investors will do well, and then the companies will continue. There's other factors going on today too. Well, and actually, just while you were talking, Adrian, I was thinking, don't forget, and David, between 2011 and 2016, the gold price went down and down and down. Now, in a declining gold price, every single gold stock goes down, as it should. In a rising gold price, they should go up. So when a gold stock goes down, and believe me, I've run a lot of companies. I've founded 15 companies in my career. I've been in this game a long time. Stock goes up, investors think they're the smartest investors on the planet. The stock goes down, it's always management's fault, right? So that's the world we live in. If you live in a market where the gold price goes down, stocks are going to go down, investors are going to blame the companies and think it's a terrible business. The reverse happens when gold stocks go up, and I think we're in that world right now. It's a world where, generally speaking, yes, there's been a few problems, and you mentioned Mali and Panama. That's absolutely true. The solution to that is to have a diversified portfolio. Diversified portfolio will shield some of those single country grenades or single asset grenades that generally happen in this business. But there's lots of good stories too, and there's lots of fundamental value being created. That's what investors want to hold on to, and you never get that buying the commodity. You get that buying the stocks.
And if I could add to that, Ross, have a look at the production profiles, 5 years out on all those majors. They need the mid-tiers, and the mid-tiers need the juniors, because flat isn't up, right? We just don't see growth, and some of these big companies, they have an incredibly voracious appetite. They're producing a lot of gold, and their reserves and resources aren't going to survive them long enough. There's a lot of very tired assets especially in the senior space, and so there will be M&A activity in this because that's the only way they can actually try to maintain production, much less grow.
Another interesting phenomenon is the underperformance of silver relative to gold. Not just underperformance, but just lack of leverage. I don't mean underperformance in nominal terms, but since we're talking about the underperformance of equities, to gold? I might as well bring this up as well. I think we're all involved in some way with silver as well. Can you describe that phenomenon? Usually silver has a higher beta to gold. Why not this?
It does. If you go back and look at what silver's done now again, we've just talked about this gold market starting in the East, more or less in the Middle East, and it's a bit of a unique bull market that started. And those investors, not only do they not buy the ETF, they don't buy the equities, they're also not all that interested in silver. Central banks, there used to be central bank reserves in silver, and I hear rumors of it every once in a while on some foreign land, but it hasn't been a part of central bank purchases for a long time, and I wouldn't predict it to become that level. What excites me about silver is the industrial demand. It keeps on growing. As we do get more and more concerned about efficiencies and trying to make mobile electronics, whether it's cars or microphones, last longer, work better, the more silver you use, the better they work, period. Simple as that. And so there is demand there, but it's not driven by that retail space. Now, if you go back and look at every gold, silver, precious metals bull market, gold always moves first, silver lags, and then outperforms. I always remind everyone, it also outperforms on the way down. So you got to make sure you get your timing right. But I do think that we're starting to see a bit of a waking up, and some of the equities are showing that indications. There has been a bit of strength in the GLD and the ETF holdings, off and on through the last year, but definitely not down, which is what we were seeing for a couple of years before that. And so that tells me that there is some strength starting to build in the West. Gold has moved the price, but I think a lot of that is central bank purchasing. As we start to see more support for gold from the traditional sectors, silver will have its time.
Ross, I've read from several reports that perhaps silver will enter even bigger deficit in the coming years. How is the silver industry responding to that?
Well, silver is in pretty good shape. Gold's got great legs. Silver's got great legs. Silver has good legs with being a precious metal, as Randy said, and also having extraordinary industrial demand growth, mainly out of the photovoltaic industry, but lots of other industries. So it's a good commodity. The equities in silver are probably even better than gold, actually, because there's so few of them. And last year, among the two best performing mining stocks, period, were the two silver plays, pure play silver plays, Gatto and Silvercrest, that were both taken out at fabulous premiums and have since done very well. So there's so few silver names because it's a rare commodity to find as a primary product in a mine. It's mostly a byproduct metal. If you get your hands on a really good primary silver deposit, it's going to have a premium valuation. And if you couple that premium valuation with a nice run in the silver price, it's going to be another pretty good year for silver investors.
Yeah, I just reinforce that because our business is looking at new developments, and most people don't realize that most silver comes from lead zinc mines. I haven't seen a lead zinc project come across my desk for a long time, and that's where most silver comes from, is a byproduct from lead zinc mines and from copper mines. And so the supply side is getting squeezed more and more as we see increasing demand. It's a perfect combination.
And that the macro for the silver industry, which is most silver is byproduct silver, it also is reflected in the mines. There are in the mining companies, there are very few pure silver mining companies. Most silver companies, including Pan American, get a lot of their revenue from gold. A lot of their revenue doesn't come from silver. And so there are really, a lot of the companies that are called silver, I won't name them names, but a lot of the companies that are so-and-so silver still get the majority of their revenue from gold. That doesn't make them a bad company. It just means that they're not pure play silver. So pure play silver mines are just very, very rare. And as Ross said, when silver moves, these stocks tend to have exaggerated moves.
Yes. What are your outlooks on capital raising and fundraising into the next couple of years? Do you think liquidity conditions are in place for raising capital if needed? The Fed, for example, has indicated they may pause rate cuts given how sticky inflation has been. What's your opinion?
Well, I've been in the capital markets in a pretty significant way in the last year to complete the construction of our Greenstone mine and to buy out our partner. So we've raised between $1.5 and $2 billion. And actually, David, markets are pretty good. The markets are pretty good. If you're raising money, if you have a really great project, for that type of company, it's diversified, it's got a good income statement, a good outlook on growth. you know, for that type of company, Equinox Gold, it's been really readily available. Of course, it all depends on the project and, you know, the details of the company, but capital has been there both from institutional investors on the equity side and from banks. And we've had a very, very receptive banking community, even though the interest rates are a lot higher now than they were a couple of years ago. So that doesn't exactly, it's not exactly great for big borrowers, but what else can you do?
I think Ross put his finger on it when he said for good projects. You know, if you're raising $1 billion for a good project, you can do it. If you're trying to raise $5 million for a bad project, then you're going to have a tough time. And a lot of the smaller companies, you know, they are having a tough time raising, you know, $2, $3, $4, $5 million. And basically because, you know, that money is just circulating. If someone puts $5 million into, you know, company A, they're probably selling company B to raise the money to buy for company A. Yeah, but I think in the last few months in particular, the smaller companies are having a great deal of difficulty raising money.
Wheaton's in the business of supplying capital, and you know, I'm going to say that, to be honest, the selection seems to be, I really do think we're starting to see the results of the lack of risk capital being spent, because we're not seeing as many new projects out there. We get the occasional ones. There has been some good stories in the gold space and more recently in the copper space, but we're not seeing anywhere near as much as what we've seen in the past, and so the opportunity set has definitely shrunk down from that space. And so, you know, it really comes down. Some projects are clearly financeable. Greenstone was a great mine, being built by a company that's got a good, strong track record and good support behind it. So I'm not surprised that debt was readily available to them. In our business, we're not really competing with the debt. We try to supply the equity side because we're an equity investor. We take a share of the metal that's being produced from these mines and move forward. And tell you, you know, a market like this is very attractive for us at the smaller end of the scale. If you're dealing with single asset companies, doing a financing from Wheaton is a lot more attractive than issuing shares. And you know, both of them have a permanent effect. When you issue shares, you're diluting your existing shareholder base. And so it's a lot more costly to issue shares than it is to do a stream right now, and it just keeps our doors you know, very busy. I just wish we saw some better quality assets coming through the doors right now, but we've got some capital.
I think we're almost out of time. Maybe we'll take one or two questions from the audience, perhaps.
Thank you, gentlemen. The question I have is the coupling between equities overall and the gold and silver equities. I hear one model that if the S&P 500 or the TSX goes down, the gold stocks will go down. But then I also hear the opposite, that no, the money is going to flow out of the stock market into the gold and silver stocks. So what's your position on that? Gold
tends to be risk-centric. If there's geopolitical risks or a shift and people have concerns, gold is a comfort metal, as I like to call it. People feel more comfortable owning that in challenging times. And so it depends what's driving the S&P 500 in terms of which direction it goes. So there's a bunch of other variables that would feed into those kind of environments. But I will say that, you know, I think the phrase out of that is gold is a comfort metal. When things are bad, people like having gold in their portfolio. And that's kind of what drives it.
Yeah, and it also depends on what not only what causes the market to go down, but what kind of decline it is. If you have a market crash like 1987 or like 2008, the gold stocks will go down, and typically they will go down more than the broad market because they're thinner stocks, so you know, you get a bunch of selling in and they decline much more. Typically also they will come back sooner than the broad market. So in 2008, for example, the gold stocks declined much more than the S&P, but the gold stocks bottomed in October of 2008 and had doubled by March before the S&P had even hit bottom. So yes, they decline, but they decline sooner. Now, if you have that's not an absolute rule, however. You look at the bursting of the dot-com bubble in 2000, well, that was the launch of the gold bull market. So there is no hard and fast rule.
Actually, that's a good way to end, because I don't think there's a lot of hard and fast rules about the world right now. I mean, I have no idea how the Trump presidency is going to end. and what it's going to do to the gold price. Is it going to be strong dollar, weak dollar, higher yields, lower yields, more inflation, less inflation? How's the S&P going to do? I just don't know. But in the last couple of years, gold has gone up against a lot of naysayers in North America amongst the real smart guys in New York, smart people in New York, and all the eggheads in Toronto, who all predicted a bearish world when dollar got stronger, interest rates went up, quantitative easing ended, tightening was going to start. They were all wrong. Gold went up. And different pool of buyers, different rules today. I'm looking forward to a really good year for both gold and gold equities.